Okay, so now we are revising this chapter of financial institutions. So this chapter describes the major types of financial institutions operating in financial markets. It covers the main features of the central banks, investment exchanges, the role played in the financial markets by commercial banks, merchant banks, micro lenders, collective investment schemes, investment management companies, self-administered retirement funds, life insurance companies, and non-life insurance companies. So I have prompted ChatGPT for a summary or just for more context on the section of the South African Reserve Bank, right? So I'm just gonna read over the response. What was my prompt? Okay, financial institutions overview. Okay, I said, hi ChatGPT, please explain in an easy to digest context and more practical South African case studies. I'm not interested in bullet points at the moment. My focus for now is the overall understanding of the content. Explain in paragraph format to someone who's an actuarial graduate. Remember full paragraphs, no bullet points or lists. Give examples where possible to aid understanding. So that was on financial institutions, where specifically the section of the South African Reserve Bank, right? So now, understanding financial institutions in the South African context. So when we talk about financial institutions in South Africa, we're really describing the ecosystem that moves money around the economy, right? Understanding financial institutions in South Africa, or understanding financial institutions in the South African context. When we talk about financial institutions in South Africa, we are really describing the ecosystem that moves money around the economy, manage risks, create investment opportunities, and protect consumers. Each type of institution plays a different role, and as an actuarial graduate, you'll often see how they interact when you are working on pricing, risk management, investments, or regulatory reporting. For example, when a life insurer invests the premiums from policyholders, it relies heavily on commercial banks, collective investment schemes, the JSE, and the South African Reserve Bank monetary policy decisions, meaning the whole system is interconnected. So understanding these links makes it easier to see why regulation, capital requirements, and financial stability measures are so important, right? So now on to the South African Reserve Bank, the SARB for short, what it really does in practice. The South African Reserve Bank is at the center of South Africa's financial system because it is responsible for keeping inflation stable and protecting the value of the rand. The famous 3 to 6% inflation target is not just an abstract number, it guides decisions that directly affect interest rates, mortgage payments, investment returns, and even insurance pricing. So, for instance, if inflation is rising too quickly, the South African Reserve Bank raises the repo rate. A higher repo rate filters through to all borrowing costs in the economy, right? And then suddenly banks will charge more for loans, consumers slow down spending, insurers face a reduced insurers face reduced new business in certain lines of business, and investment managers adjust portfolio strategies towards fixed income because of rising yields. So, as an actuarial graduate working in product development or asset liability management, you will feel the impact of these report decisions when modeling profit margins, lapse assumptions, or capital requirements. So, beyond the monetary policy, the South African Reserve Bank's mandate under the Financial Sector Regulation Act is to protect financial stability. This is more than just monitoring the economy. It involves preventing systemic risk, which is the risk that one institution's failure triggers, systemic risk is the risk that one, where am I? I'm getting lost in my notes. Okay, so beyond the monetary policy, the South African Reserve Bank's mandate under the Financial Sector Regulation Act is to protect financial stability, right? This is more than just monitoring the economy. It involves preventing systemic risk, which is the type of risks that one institution's failure triggers a chain reaction in the whole system. It's like a domino effect. If one institution falls, the rest of the other financial institutions will also fall. So in practice, this means the SARB oversees the Prudential Authority, which supervises banks and insurers to ensure they hold enough capital, they manage risk properly, and do not take decisions that could threaten the broader financial system. For example, when a life insurer invests too aggressively in risky assets, or when a bank has high exposure to unsecured lending, the Prudential Authority, or the PA, intervenes through capital requirements, right? The PA intervenes through capital requirements, risk governance reviews, or supervisory actions. Actuaries are often central to these engagements, especially in ORSA submissions. In ORSA submissions, capital modeling, and risk management. A key part of maintaining financial stability is acting as the lender of last resort. So the Reserve Bank also acts as a lender of last resort. So this role becomes relevant in exceptional circumstances such as a bank run. If a commercial bank suddenly struggles to meet withdrawal demands, the South African Reserve Bank can step in with emergency liquidity. This is not something that happens often in South Africa, but the principle gives confidence to the market and helps avoid panic-driven collapses, right? As an example, say during COVID-19, the South African Reserve Bank injected liquidity into the bond market to avoid a freeze in trading, which indirectly affected the valuation of insurers and pension funds' investment portfolios. The South African Reserve Bank also plays a major role behind the scenes in operational aspects of the economy. One important example is managing the national payment system, which ensures that payments clear safely and efficiently, right? When you buy airtime, transfer money via an EFT, or your insurer collects a debit order, these processes rely on the stability of the NPS, the National Payment System. If this system fails, even for a day, the entire financial sector would experience disruption ranging from failed salary payments to delayed investment trades. Another practical aspect of South Africa, another practical aspect of the South African Reserve Bank's work is managing South Africa's foreign exchange and gold reserves, right? These reserves act as a buffer during global economic shocks. For example, if if international investors suddenly pull capital out of emerging markets, the South African Reserve Bank may use reserves to smooth volatility in the rand and prevent a currency crisis. For insurers and retirement funds, sudden currency swings affect the valuation of offshore investments and hedging strategies. So, the South African Reserve Bank subsidiaries each play a unique role in supporting the system. The SA Mint and the SA Banknote Company are essentially currency factories, ensuring South Africa always has high quality notes and coins. The Corporation for Public Deposits provides a safe place for government entities to park short-term cash. The Corporation for Public Deposits provides a safe place for government entities to park short-term cash. And this money is then invested in low risk treasury The Corporation for Public Deposits provides a safe place for government entities to park short-term cash, and this money is then invested in low risk treasury instruments supporting government funding. So actuaries sometimes interact with these through modeling interest rates. Actuaries sometimes interact with these through modeling interest rate curves or government bond yields. One of the most impactful new developments is the Corporation for Deposit Insurance, CODI, which became fully operational in April 2024. CODI introduces a formal deposit insurance scheme that protects individuals' bank deposits up to 100,000 if their bank fails. This is similar to international systems and boosts public confidence in the banking sector. For a practical example, imagine a small community bank facing insolvency. Without deposit insurance, depositors might panic and withdraw their funds, accelerating the collapse. With CODI in place, depositors know that their first 100,000 rands is protected, which helps maintain stability, right? And avoids an unnecessary bank run. So, as an actuarial graduate, this matters because more stable banks mean lower systemic risk for the whole financial sector, including insurance companies and pension funds that hold bank-issued debt instruments, right? Another important shift is that the South African Reserve Bank became the official resolution authority in 2023. This means that the South African Reserve Bank has the legal power to step in early when a financial institution shows any signs of distress. Another important shift is that the South African Reserve Bank became the official resolution authority in 2023. This means that SARB has the legal power to step in early when a financial institution shows any signs of distress, with the goal of resolving the situation in an orderly way. So instead of letting a bank fail abruptly, the Reserve Bank can implement tools such as bail-ins, bridge institutions, or transfers of assets and liabilities. This function directly protects policyholders, investors, and the broader financial system. If you work in risk, capital, or regulatory compliance at an insurer or at a bank, you will see how resolution planning affects reporting, capital structures, and recovery plans. Right. So finally, the Monetary Policy Committee of the Reserve Bank is where the repo rate decisions are made. The MPC meets every 2 months, and the announcement often has immediate effects on markets. After the MPC meeting, the SARB releases a detailed statement explaining its decision. Analysts, investment managers, banks, and insurers study this closely because even a 25 basis point change influences borrowing costs, investment returns, and policyholder behavior, right? So, for example, a higher repo rate can reduce surrenders in life insurance saving products because policyholders prefer to earn higher interest, while also increasing lapses in credit life insurance because loan repayments become more expensive. As an actuarial graduate, recognizing these links helps you understand why economic assumptions in pricing and valuations must be aligned with macroeconomic trends. That is a section of the South African Reserve Bank. Okay, we still need to look at the influence of the bank on investment markets, right? So the South African Reserve Bank, I'll come to the section of the influence of the bank on the markets. Now I'm just going through some general info about the South African Reserve Bank from the notes. The South African Reserve Bank, the primary mandate of the Reserve Bank as per the Constitution is to pursue and maintain price stability, to protect the value of the currency together with balancing economic growth and enhancing financial stability. The bank has set its target inflation rate as being between 3% and 6%. The sub-statutory mandate as per the Financial Sector Regulation Act is to protect and enhance financial stability. This includes identifying and mitigating systemic risk and strengthening the integrity of financial institutions through the Prudential Authority. The key functions of the Reserve Bank include formulating and implementing monetary policy, protecting and enhancing financial stability, including acting as a lender of last resort in exceptional circumstances, promoting and enhancing the safety, soundness, and integrity of all financial institutions regulated by the Reserve Bank, such as commercial banks, insurance entities, and market infrastructures. Another function includes enhancing the country's resilience to financial shocks, ensuring the cost-effective availability and integrity of our currency, ensuring the compiling economic statistics and conducting analysis and research, ensuring the effective functioning of the national payment systems, administering the country's prudential and capital flow measures, managing the official gold and foreign exchange reserves of the country, act as a banker to the government. So the SARB has wholly owned subsidiaries, right, which include the SA Mint Company and the SA Banknote Company, which produce coins and banknotes for South Africa. And then we also have the Corporation for Public Deposits, the Corporation for Public Deposits accepts deposits from the public sector and invests these deposits in the short-term money market instruments and treasury bills. And then we have Corporation for Deposit Insurance, CODI. This is a legal entity within the Reserve Bank that this is a legal entity within the Reserve Bank that provides protection to depositors to have access to their money should their commercial bank fails, right? And it covers or insures deposits of up to 100,000 rands. The deposit insurance scheme has become fully operational from April 2024. Yeah, so that is generally okay. Another point is about being a resolution authority. In accordance with the Financial Sector Laws Amendment Act, the South African Reserve Bank became the resolution authority for designated institutions on which date the for designated institutions, I'll end it there. Now, this will provide the SARB with additional powers to ensure the orderly resolution of any designated institution. Right, I think this is the part where I said the Reserve Bank has a duty to immediately step in when it senses that a particular financial institution is at a financial distress, right? So it has to step in, as one of its mandate is to maintain financial stability and protecting the entire financial system as a whole by reducing systemic risk, right? And then now, we also know that the bank has a monetary policy committee which is chaired by the governor of the Reserve Bank. It meets once every 2 months. After their meeting, it releases a statement on monetary policy, including declaring the repurchase rate or the repo rate, which is an official interest rate that the Reserve Bank uses in its dealings with commercial banks. All right, now we are going to look at the influence of the Reserve Bank on financial markets. We have the money market, the currency market, and providing information to investment markets. And then also looking at the financial markets department of the Reserve Bank. So traditionally, the money market refers to interest rate. Let me take a sip of my coffee. All right, now we're on the influence of the bank on investment markets. Looking at the money market. So traditionally, the money market refers to interest rate instruments with a duration of less than 1 year. Let me quickly Google the definition of a money market. What is a money market? Not a money market account. What is a money market? A money market is a wholesale market. Now, this is a definition of a money market according to Google. A money market is a wholesale market for short-term borrowing and lending. Short-term in this case means less than a year, right? A money market is a wholesale market for short-term borrowing and lending using highly liquid, low-risk debt instruments like treasury bills, commercial paper, bank deposits, allowing entities to manage cash flow. For individual investors, money market often refers to money market mutual funds or accounts which pool money to invest in these instruments for better returns than normal savings account, offering high liquidity and capital preservation. It's not a physical place, but an electronic network for banks, corporations, and governments to meet short-term funding needs and for investors to park cash safely. Key aspects of the money market. It is short-term focused, deals with debt maturing in days. It involves deals with debt maturing in days, weeks, or up to a year, making it ideal for short-term cash management. Another key aspect is high liquidity. Instruments are easily convertible to cash with high safety and low risk. Another key feature is wholesale nature. Traditionally, it involves large transactions, for example, millions per day, but money market funds, unit trusts, allow smaller investors to participate. Instruments traded in the money market include treasury bills, certificates of deposit, commercial paper, repurchase agreements, repos, and interbank loans. So how the money market funds how money market funds work for investors. Okay, I'm not interested in that for now. Who uses the money market? Borrowers and lenders. Borrowers means governments, banks, and companies needing quick, short-term cash. Lenders or investors. Investors seeking a safe place to temporarily hold cash, earn interest, and maintain liquidity. All right, that is the money market according to Google. Now back to my notes. So the money market, traditionally the money market refers to interest rate instruments with a duration of less than a year. While this is generally accepted convention, the regulations are not precise in this regard, and investment regulations for various investment products differ in their definitions. The money market covers bank deposits and short-term securities such as treasury bills, promissory notes. The Reserve Bank plays a direct role in the market for short-term securities. The Reserve Bank plays a direct role in the money market for short-term securities with the primary aim of influencing interest rates. So the aim of the Reserve Bank to participate in the money market is to influence interest rates. That's what I'm getting from this sentence, at least. So the bank plays a direct role in the market for short-term securities with the primary aim of influencing interest rates. It interacts with private sector markets in order to provide a stable financial environment in which banks and other market participants can manage their liquidity. In its money market operations, the Reserve Bank manages the overall levels of liquidity. It manages the overall levels of liquidity, right? It manages the overall levels of liquidity in the market through various transactions. This includes regular intervention in order to create or drain liquidity, right? In addition to levying a cash reserve requirement on banks. Levying a cash reserve requirement. What does it mean to say levying? Levying meaning. Let me search Google for levying meaning. Levying means to impose a tax, a fee, or a fine. Ukukhokhisa. So levying a cash reserve requirement on banks means imposing a cash reserve requirement on banks. Imposing meaning demanding, charging, imposing a cash reserve requirement on banks. Right, okay. So in its money market operations, the bank manages the overall levels of liquidity in the market through various transactions. This includes regular interventions in order to create or drain liquidity, in addition to levying a cash reserve requirement on banks. The bank also uses various types of open market instruments such as Reserve Bank debentures, longer-term reserve repurchase agreements, and foreign exchange swaps to drain excess liquidity. Once per week, the bank invites banks to tender for the amount of refinancing they need, this transaction being conducted at a fixed repo rate. By providing the liquidity needed by the banking system for settlement of money market transactions, the banks acts as the marginal supplier of money to the banking system. It acts as a marginal supplier of money to the banking system, enabling effective system-wide liquidity management in normal market conditions. So that is its influence on the money market. So what I'm getting is that It manages overall levels of liquidity. It imposes a cash reserve requirement on banks. It drains excess liquidity. It also creates liquidity. It acts as the marginal supplier of money to the banking system. Okay. Now, what is its influence on the currency market? Oops. Okay. What is its influence on the currency market? The government maintains a large amount of gold and foreign currencies, collectively known as the foreign reserve. By selling foreign reserves in exchange for a rand, by selling foreign reserves in exchange for rands, the Reserve Bank can decrease the supply of the rand and so increase its price in terms of other currencies. Similarly, if the government feels that the rand is overvalued, the bank can sell the rand, thus increasing the foreign reserve to force the exchange rate down. Okay. And then another point, okay, that is on the currency market. Another influence that the Reserve Bank has on investment markets is through providing information to the investment markets. The Reserve Bank publishes a great deal of information which will be of interest to investors in the financial markets and thus indirectly influences the markets. Reserve Bank publications include working papers, research papers, bulletins, and statistical reports. The Financial Markets Department of the Reserve Bank has some key functions. These include implementing the Reserve Bank's monetary policy decisions. This entails refinancing the bank's liquidity requirements through repurchase transactions and other facilities such as the averaging of cash reserves or marginal lending, as well as managing liquidity in the money market through open market operations such as debentures, long-term reverse repurchase transactions, and foreign currency swaps. Participating in the spot. Another role or function includes participating in the spot and forward foreign exchange markets to service the foreign exchange needs of the Reserve Bank and its clients. Acting as a funding agent to the government. Acting as funding agent of the government by conducting bond and treasury bills auctions. Participating in the formulation of debt management strategies, conducting surveillance over primary dealers in the bond market, and managing the investment portfolio of the Corporation for Public Deposits. Another role includes facilitating the effective functioning of the domestic financial markets through its participation in these markets, managing the Reserve Bank's gold and foreign exchange reserves. All these are the functions of the Financial Markets Department of the Reserve Bank. So, managing the Reserve Bank's gold and foreign exchange reserves, maintaining correspondent banking relationships by interacting with the bank's counterparties, both domestic and foreign, to assist with the Reserve Bank in achieving its goals. An important aspect of this function is the negotiation and administration of foreign loans or credit lines, which the bank may draw down from time to time to augment its foreign exchange reserves. Another function includes providing market information and analysis to assist the governors in their decision making, providing custody and settlement services to the government and the banks, managing the risk inherent in gold, foreign exchange, refinancing, and government activities. Those are the functions of the Reserve Bank. Those are the functions of the financial market departments of the Reserve Bank. Now on to ChatGPT to help with further understanding of that section. I'm just looking for that prompt. Said, hey ChatGPT, please explain in an easy to digest context and more practical essay case studies and examples. Explain in paragraph form to an actuarial graduate. Since this section of the influence of the Reserve Bank on investment markets feels quite complex and difficult to understand, please explain as if I'm a first-year student in actuarial science. Help understand how the bank influences liquidity, what is repurchasing, what is the money market exactly. Yeah, so that is my prompt. All right, so understanding the Reserve Bank's influence on investment markets. One of the easiest ways to understand the Reserve Bank's influence on investment markets is to imagine the financial system as a giant plumbing network, right? Money flows in and money flows out through banks, through insurers, investment managers, and through borrowers. Liquidity is simply the amount of water, money in this case, available in the system at any point. The Reserve Bank acts as the master controller of these pipes, making sure there is neither too much nor too little water flowing. Too much liquidity causes interest rates to fall and can trigger excess borrowing or inflation. All right, I'm interested in this point particularly, so I'm gonna open a different window and prompt how does too much liquidity cause interest rates to fall. How does too much liquidity causes interest rates to fall and can trigger excessive borrowing or inflation? Okay, so when people say too much liquidity causes interest rates to fall and can trigger excessive borrowing or inflation, they are describing a chain reaction in the financial system. It helps to think of liquidity as how much cash is floating around in the economy and how easily people can access it. When liquidity is very high, money is cheap and plenty. That changes behavior across households, firms, and financial institutions, including in South Africa, in a way that can become risky if it goes too far. Why interest rates fall when liquidity is high? When banks and investors are holding a lot of cash, they are eager to lend it out or invest it, right? But because everyone has more than enough money, they start competing with each other for borrowers. The easiest way to compete is to offer lower interest rates. So the abundant supply of money pushes the price of money, the interest rate, down. Interest rate is the price of money. Okay. So when banks and investors are holding a lot of cash, they are eager to lend it out to or to invest it. But because everyone already has more than enough money, they start competing with each other for borrowers. The easiest way to compete is to offer lower interest rates. So the abundant supply of money pushes the price of money, the interest rate down. It's the same logic as any market. If there's too much of something, the price of that something has to drop. So in South Africa, you could imagine a situation where the Reserve Bank injects lots of liquidity, for example, during COVID-19, using bond buying programs, or where banks simply have far more deposits than loan demands. Lending markets become flush and the cost of credit falls. So, why lower interest rates lead to more borrowing? Once money is cheaper, households and companies start borrowing more because the monthly payments, the monthly repayments are easier to manage, right? So, when interest rates are lower, that leads to more borrowing because the cost of borrowing is now cheaper. So, a South African example might be the home loan boom in the mid 2000s. Interest rates dropped, banks had abundant liquidity, and suddenly households were taking on mortgages, car loans, and personal loans at a rapid pace. Businesses also expand more aggressively because they can access cheap funding for new buildings, equipment, or acquisitions. So, this is not necessarily a problem. In fact, it can stimulate growth until the borrowing becomes excessive and driven by cheap credit rather than the real economic opportunity. All right, this sentence is a bit not clear. This is not necessarily a problem. In fact, it can stimulate growth until the borrowing becomes excessive and driven by cheap credit rather than real economic opportunity. Okay, how this can trigger inflation? All right, more liquidity plus more borrowing equals more spending power circulating in the economy. If everyone suddenly has more money and is spending more, but the supply of goods and services can't increase as quickly as there is more money, the imbalance pushes prices of goods and services up. That's the classic path to demand pull inflation. A South African case study is the pre-2008 period. Cheap credit and rising household debt led to a surge in consumer spending on loans. A South African case study is the pre-2008 period. Cheap credit and rising household debt led to a surge in consumer spending on cars, furniture, housing upgrades, and imported goods. Because domestic production couldn't keep up, inflation started climbing beyond the Reserve Bank's 3 to 6% target range. The Reserve Bank eventually responded by hiking rates sharply to cool things down. It also fuels asset price inflation. Too much liquidity doesn't only it also fuels asset price inflation. Okay. Too much liquidity doesn't only inflate the cost of groceries, it can inflate asset prices such as houses, shares, bonds, and even crypto, right? So if investors have too much money, if investors have too much cash earning low interest, they start chasing higher returns. This pushes up prices in a way that may not reflect fundamentals. If investors have too much money, let me start over with this part of asset price inflation. I was distracted a bit. It also fuels asset price inflation. too much liquidity doesn't only inflate the cost of groceries. It can inflate asset prices, such as houses, shares, bonds, and even crypto. If investors have much cash earning low interest, they start chasing higher returns. This pushes up asset prices in a way that may not reflect fundamentals. Okay, the way I'm understanding this is that investors have a lot of cash lying around which is earning low interest. Maybe it is saved in a savings account somewhere and it is earning low interest because they feel that their money is not earning what it should be earning in terms of interest. They end up purchasing other asset classes. Maybe say they buy property, they buy shares, they buy bonds, because there's a lot of cash lying around and it is not beneficial to keep it in a savings account. You'd rather maybe use that cash to buy an asset such as a house, a, a, such as a house, shares, or even crypto. So because a lot of people have excessive cash lying around, it means a lot of people can afford these assets, right? So now the demand for those assets will increase. Now an increase in demand will naturally push up the prices of those assets. That's how I'm getting this. So an example, in South Africa, property markets have seen periods of credit-driven price inflation, especially in certain metros. On the JSE, when global liquidity is high, foreign investors pour money into when sorry, in South Africa, property markets in South Africa, property markets have seen periods of credit-driven price inflation. Credit-driven price inflation, especially in certain metros. On the JSE, when global liquidity is high, foreign investors pour money into emerging markets, pushing up the prices of equities and bonds, even if earnings or growth don't justify it. Okay. When the liquidity eventually dries up, asset prices fall back to reality, and that can be very painful. Okay. So why too much liquidity is dangerous? The danger is not the liquidity itself, it is the behavior it encourages. Banks can get comfortable and loosen their lending standards, right? Households take on debt they can't manage when rates rise again. Asset bubbles form, inflation erodes purchasing power, especially for low-income households. So in an actuarial setting, you see this show up in credit risk models, asset valuation, scenario testing, and even insurance lapses, because cheap credit can temporarily reduce policy lapses, but rising interest rates later increase the lapses. So too much liquidity means lower interest rates. Lower interest rates means more borrowing. More borrowing means more spending and investment. More spending and investment mean rising prices of goods and assets. Rising prices means risk of inflation or credit bubbles. So that is how too much liquidity eventually leads to inflation. So governments and central banks try to balance liquidity precisely because they've seen what happens when the system becomes overly flush, inflation spikes, asset bubbles form, and financial stability risks multiply. All right, so yeah, so I was still on understanding. So that was a side tangent. Now back to our notes. I was still on understanding the SARB's influence on investment markets. So we said one of the easiest ways to understand the SARB's influence on investment markets is to imagine the financial system as a giant plumbing network. Money flows in and money flows out through banks, insurers, investment managers, and borrowers, right? Liquidity is simply the amount of money available in the system at any point. Liquidity is simply the amount of water, money in this case, that is available in the system at any given point. So the SARB acts as the master controller of these pipes, making sure there is neither too much nor too little water flowing. Too much money causes interest rates to fall and can trigger excessive borrowing or inflation. Too little liquidity can make credit scarce, pushing interest rates up too sharply or cause panic in the markets. Because banks must settle millions of rands of payments each and every single day, from ATM withdrawals to debit orders to investment trades, they need predictable access to liquidity. So the South African Reserve Bank's job is to keep the pipes flowing smoothly. Right. What exactly is the money market? The money market is simply the part of the financial system where very short-term borrowing and lending happens. The money market is simply the part of the financial system where very short-term borrowing and lending happens. When you hear less than 1 year, think of things like a 3-month treasury bill, 6-month fixed deposits, and an overnight lending between banks. Companies, insurers, banks, and even the government all use the money market to manage short-term cash needs. For example, if a short-term insurer has a sudden spike in claims from a hailstorm in Gauteng and needs cash quickly to pay those claims, it might temporarily invest less in long-term bonds and place more funds in the money market because it knows the money will be accessible soon, right? Now, the Reserve Bank directly influences this market because if the money market becomes unstable, every other part of the economy suffers. Interest rates can behave erratically, banks may struggle to settle payments, and investment managers may panic. So the Reserve Bank keeps the short-term interest rate, the repo rate, stable by managing how much money is in the system. How the Reserve Bank manages liquidity. Imagine all commercial banks in South Africa keep daily cash accounts at the Reserve Bank. They use these accounts to settle payments with one another. If, for example, Capitec clients send millions of rands to Nedbank clients in one day, Capitec must transfer that cash from its Reserve Bank account to Nedbank's Reserve Bank account. If Capitec doesn't have enough cash in its Reserve Bank account, it needs to borrow it either from another bank or from the Reserve Bank itself. This is where liquidity becomes important. If the entire banking system is short of cash at the same time, interest rates would shoot up and banks would struggle to function. So to prevent this, the South African Reserve Bank regularly adds liquidity to the system or removes it, depending on what the economy needs at the time. So if the If the Reserve Bank thinks there is too much money in circulation, for example, after government spending increases sharply, it will drain liquidity by offering financial products like the Reserve Bank debentures or using reverse repurchase agreements to pull money out temporarily. If liquidity is too low, for example, after a tax season when everyone pays SARS, the Reserve Bank will add money back into the system to ease the pressure. And then now understanding repos and reverse repos. A repurchase agreement or a repo is simply a short-term loan, but one where the bank gives the Reserve Bank a financial asset, usually a government bond, as temporary security. Think of it like borrowing money from a friend and giving them your laptop as security, promising to buy it back later at a slightly higher price. That slightly higher price is where the repo rate comes in. It's the interest rate the bank pays to borrow money from the Reserve Bank. Each and every week, the Reserve Bank invites the banks to borrow the liquidity they need at the official repo rate. This is the mechanism through which the Reserve Bank keeps short-term interest rates stable. If the repo rate goes up, borrowing becomes more expensive, so banks charge higher interest rates to their customers. If the repo rate goes down, borrowing becomes cheaper and interest rates in the economy fall. Reverse repos are the opposite. Here, the Reserve Bank is lending money to the banks but removing liquidity from the system. The Reserve Bank is lending money to the banks but removing liquidity from the system. So the Reserve Bank will ask the banks to give cash in exchange for an asset. And the banks later repurchase the cash position. This drains cash because the banks temporarily hand over money to the Reserve Bank. This is a bit confusing. Let me ask in a different window. How does this work exactly? Please explain this part. So understanding reverse repos by imagining the direction of cash. A reverse repo sounds confusing because the wording is opposite. The wording is opposite depending on whose perspective you take. The easiest way to understand the reverse repo is to track who ends up with the cash during the transaction. Okay, so with the reverse repo, from the Reserve Bank's perspective, the bank gives cash. From the Reserve Bank's perspective, okay, the banks give cash to the Reserve Bank now. So the South African Reserve Bank gives a government bond or other security as temporary collateral. Later, the Reserve Bank returns the cash plus a small interest amount, and the banks return the security. Even though the Reserve Bank technically borrows cash from the banks in this setup, the outcome is simple. Cash leaves the banking system and sits with the Reserve Bank for a few days, so liquidity in the market drops. right? This is why we say it drains liquidity. Why the Reserve Bank uses reverse repos? Think of the Reserve Bank as trying to keep the money taps at the right flow. If banks are swimming in too much cash, interest rates start drifting below the repo target. That's a problem for monetary policy. So the Reserve Bank performs a reverse repo to pull some of that extra cash out just for a short period to keep the overnight interest rate aligned with its repo rate corridor or target. A practical South African scenario: imagine it's a month when government has just paid old age grants. So big corporates have paid salaries, and several export companies have brought. Imagine it's a month where government has just paid old age grants, big corporates have paid salaries, and several export companies have brought dollars into the country and converted them into rands. This injects a lot of liquidity into the banking system. So banks now have more cash than they need, right? So if the Reserve Bank does nothing about this, the overnight interest rates will fall below the repo target, because banks are basically shouting, who wants more money? We have too much of it. Okay. So to fix this, the Reserve Bank runs a reverse repo auction. The banks send 20 to 30 billion in cash into the Reserve Bank's account. The Reserve Bank then gives them bonds as collateral. For the next 1 to 7 days, depending on the maturity, that cash is no longer circulating in the banking system. Liquidity tightens back to normal levels, and overnight money market rates move back in line with the Reserve Bank's repo target. Why it removes liquidity even though the Reserve Bank is the one borrowing? It helps to think of the Reserve Bank as a sponge in this case. Even though the Reserve Bank is technically borrowing the cash, the important part is banks no longer have that cash available to lend to customers, invest the cash, or settle payments. It sits idly at the Reserve Bank until the transaction unwinds. So the system's usable liquidity shrinks for the duration of the contract. How this fits into the broader system? Reverse repos are one tool among others, like the Reserve Bank debentures, FX swaps, cash reserves requirements, and final settlement balances. But reverse repos are very nimble and can adjust liquidity day to day without major structural effects. So for an actuarial graduate, the important insight is that liquidity management is part of how the Reserve Bank ensures interest rates behave in a predictable way. When liquidity is taken out, the supply of short-term cash tightens, nudging rates back upwards, supporting the Reserve Bank's monetary policy stance. Okay, I think that makes sense. Now, how the Reserve Bank influences the currency market. Think of the currency market as a giant global auction where people trade rand for dollars, euros, and other currencies. The South African Reserve Bank holds reserves of these foreign currencies and gold. The South African Reserve Bank holds reserves of these foreign currencies and gold. The South African Reserve Bank holds reserves of these currencies and gold. When the Reserve Bank sells dollars to buy the rand, it reduces the supply of the rand in the market. A lower supply of the rand pushes up the value of the rand. This is similar to how buying back shares increases the share price because there are fewer shares in circulation. Okay. For example, if global markets panic and investors dump emerging market currencies, the rand may suddenly weaken sharply, right? If the Reserve Bank believes these moves If the Reserve Bank believes that this move is too extreme, it may enter the market and buy the rand using its dollar reserves to smooth the volatility. This does not fix the exchange rate, but it calms the market. Okay, so to stabilize the value of the rand, the Reserve Bank's information role. So even when the Reserve Bank does nothing physically in the market, it still influences investor behavior by providing data. Investors study the Reserve Bank's statistical releases, economic forecasts, and research papers to form expectations about inflation, interest rates, and currency movements. For example, if the Reserve Bank's if the Reserve Bank's research indicates inflation pressures building from food or electricity prices, investors may start pricing in future interest rate hikes, which immediately affects bond yields and the JSE. The role of the Financial Markets Department of the Reserve Bank. So the Financial Markets Department of the Reserve Bank is the operational engine room where these decisions are executed. When the Monetary Policy Committee decides on the repo rate, this department ensures the banking system gets on returns. When the MPC decides on the repo rate, the Financial Markets Department ensures the banking system gets or returns the correct amount of liquidity via repos, reverse repos, debentures, or swaps. They also manage the government's debt auctions, which determine how treasury bills and bonds are priced and how investors, including insurers and pension funds, can buy into these assets. So when foreign exchange reserves need to be adjusted, for example, when South Africa receives a loan from the IMF or when global conditions change, the Financial Market Department executes those trades. So this department also plays a critical role in maintaining relationships with foreign banks, ensuring South Africa can access foreign credit lines when needed. That's important during crisis because the Reserve Bank may need access to foreign currency quickly to support the rand or settle international obligations. Their work helps maintain confidence in the financial system, which ultimately stabilizes markets and protects investors. Okay, it does make sense.